This is Chapter 2, Problem 20, to talk about consolidation as of the date of consolidation. So the following is the given problem. The following are the book values and fair values that are available for Westmont Company as of March 1st. Inventory, book value 630, fair value 600. Land, book value 750, fair value 990. Buildings, book value 1.7 million, fair value 2 million. Customer relationships, no book value, fair value 800,000. Accounts payable, book and fair value of 80,000. Then they had common stock on the books for 2 million, additional paid in capital 500,000, retained earnings as of 1/1/360, revenues 420, and expenses 280. Remember, in this problem, all credit balances, which are accounts payable, common stock, are represented by the negative or the number in the quotations. So this information was put down here. The very first thing that you want to do is calculate the fair value differences. So the fair value differences is fair value minus book value. And then on liabilities, it's book value minus fair value. And this will tell you whether it's positive or negative. You do this for assets and liabilities. So the very next thing that we are going to do is put in some given information. So given information. Churro paid $4 million in cash and issued 20,000 shares of its $2 par common stock, which had a fair value of $50 per share for all of Westmont's common stock in a merger, after which Westmont will cease to exist as a separate entity. The stock issuance costs amounted to $25,000 and Churro pays $42,000 in legal fees. So, given information, we know that their number of shares is 20,000. Change that from dollars. We know that the common stock par value is $2 per share. We know that the fair value of the common stock is $50. We also know that they paid cash of $4 million. And that they had legal fees of, if I can type here right, of $42,000 and stock issuance costs of $25,000. So, in order to figure out, so basically what we're going to do is we're going to calculate the purchase price, allocate the difference to any excess fair value calculate the excess, allocate it to any fair value differences, and then we are going to figure out goodwill if there is goodwill for this. And then we're going to make a journal entry to purchase. So, purchase price, we're going to start here. Purchase price. So it says that they paid cash of $400,000, cash of $4 million. They had common stock and the common stock equals the number of shares that they issued times the par value. So that's 40,000. And then they have additional paid in capital, also known as APIC. And that is the $50, which is the fair value, minus the par value, times the number of shares. So 960,000. So our total purchase price, we're going to add these together. So the total purchase price is $5 million. Now we must calculate book value of Westmont, because Westmont is going to cease to exist. So the way that we calculate the book value of Westmont is actually, because this is already in a negative number per se, we sum all the assets and liabilities. book value. We sum all the book value assets and liabilities right here. This is the book value of Westmont. And then in order to calculate the excess in this purchase, we take the total purchase price minus the book value. So we have $2 million in excess. Now we must allocate this to fair value differences. So anything that we calculated here is going to go down here. So the very first thing we start with is inventory, and I'm just going to link the numbers because I already made the calculation. And then the next things I have, I'm just going to copy these to save myself some typing time. We have land building. Accounts payable has no differences, so this is all we're going to do. And I'm going to go like this and link it up here. Link it. That way if I made a mistake somewhere in typing up here, I could just fix this and it would fix all my calculations. So I'm going to then calculate the remaining excess. And the way I do that is I take this minus this, minus this. And so my remaining excess is $690,000. If it is a positive number, it is goodwill. If it is negative, I would check that I did math correctly, and then it would be a bargain purchase, which means we got a deal on it. So it is goodwill. Now that we've calculated goodwill and the purchase price, we are going to make the journal entries to dissolve. Entries to dissolve Westmont. So the first journal entry that we're going to make is to write on all of the assets and liabilities of Westmont at fair value. Fair value, not book value. So I'm going to take this from the fair value column. Fair value. And then I have land. I'm just scrolling up and then and then I have buildings. And then I have customer relationships of 800,000. Negative, remember, we're not going to put negative numbers in journal entries. Negative is going to represent the credit side of this. So accounts payable. I'm going to link it. I'm putting a negative sign, swap the sign. Accounts payable. And then I'm also going to put on the credit side anything that we paid to purchase the company. So we paid $4 million in cash. Common stock. APIC, also known as additional paid-in capital. And you see I'm linking all of this so that. And now I'm going to do a double check here. I'm going to sum, remember, journal entries must balance. I know that I'm missing something, but I'm going to show you how I know. So we need to make a debit for $690,000. What am I missing? Well, the great thing about this is that goodwill is $600,000. So we'll write on all the assets and liabilities at their fair value in a dissolving journal entry, but we will also represent anything that was goodwill. So now, as you can see, my double check here, there is no difference. The journal entries are balanced. And so this is the first journal entry to dissolve. Then we have a journal entry for stock issuance cost. And a stock issuance cost is a debit to additional paid-in capital. So I'm going to take this from my, we paid $25,000, and it says we paid cash for them if we go back and check the problem. And then our final journal entry for legal fees. And it could be combination expenses, legal expenses, any of those words come from the same thing. Okay with it. And that was $42,000, and it also says we paid cash. And This is the journal entry is to dissolve Westmont if Aturo purchased them for $4 million.